the intricate web of personal finance and taxation, the allure of evading the taxman's reach by sidestepping traditional banking systems is a topic of much intrigue and misconception. Could one really avoid the burden of taxes simply by keeping money under the mattress or within the confines of a home safe? This exploration will not only unravel the legality and practicality of such a strategy, but also illuminate the broader implications and risks associated with attempting to dodge taxes through unconventional financial practices. First, let's consider the fundamental premise. Taxes are levied based on income, not necessarily on the method by which one stores that income. Whether your earnings are kept in a bank, invested in assets, or stuffed into a cookie jar, the obligation to report and pay taxes on these earnings does not change. The Internal Revenue Service, IRS, in the United States, along with similar authorities worldwide, requires individuals to report their income irrespective of the medium through which it is held or transacted. However, some might argue that avoiding banks can reduce the visibility of one's financial activities to tax authorities. It's true that banks play a critical role in the financial system, not only as safekeepers of money, but also as informants for tax authorities. Banks report certain transactions and suspicious activities to the authorities, which can include large deposits or unusual withdrawals that might indicate tax evasion or money laundering. Therefore, bypassing banks might, at first glance, appear to offer a veil of secrecy over personal finances. But let's delve deeper into the feasibility and ramifications of such an approach. Operating entirely in cash, or through similarly untraceable means, poses significant challenges and risks. Large cash transactions are difficult to manage and inherently risky. They make one vulnerable to theft or loss, and significant amounts of cash can be cumbersome to store securely. Moreover, conducting sizable transactions, such as purchasing real estate or a vehicle, typically requires some form of traceable payment method, which, if done in cash, could raise red flags with authorities monitoring for anti-money laundering. Additionally, the practical limitations of a cash-only lifestyle extend into the professional realm. For freelancers or small business owners, avoiding banks could hinder one's ability to receive payments from clients or to pay for services where digital transactions are the norm. This not only constrains business operations, but also potentially limits growth opportunities. Moreover, even if one were to successfully navigate life without banks, the legal consequences of failing to report income can be severe. Tax evasion, deliberately misreporting or not reporting income, is a criminal offense in many countries, including the United States. Conviction can lead to hefty fines and imprisonment. Tax authorities have various means at their disposal to track financial activities, even beyond the banking system. Audits, whistleblower reports, and discrepancies in reported income versus visible standards of living can all trigger investigations. But beyond the practical and legal considerations, ethical questions arise. Taxes are a fundamental tool for governments to fund public services and infrastructure. By evading taxes, individuals diminish the resources available for public schools, healthcare, roads, and law enforcement, thus affecting community welfare and social equity. This introduces a moral dimension to the discussion. Even if one could avoid taxes by not using banks, should they? This thought leads us into the broader societal impact of such action. Tax systems are designed to be contributions to societal well-being, with the collected funds being redistributed to maintain the public goods that benefit all citizens. Opting out of this system through tax evasion can undermine the social contract that binds communities together, leading to broader socioeconomic inequalities and potentially destabilizing essential public services. In conclusion, while the notion of avoiding banks to evade taxes might seem appealing to some as a way to protect personal wealth from taxation, the reality is fraught with legal, practical, and ethical challenges. The risks associated with such a strategy, from legal repercussions and operational limitations to the potential impacts on one's conscience and societal obligations, make it an unwise and ultimately untenable approach. Tax evasion, regardless of the method, is a serious crime, and the societal consequences of such actions extend far beyond one's personal finances. impacting the very fabric of community and governance. Therefore, while you might momentarily dodge the watchful eyes of the taxman, the long-term consequences could prove far more costly.